A candidate I was helping called me after a fund accounting interview. I'll call her Anisha. She had prepared NAV, journal entries, capital calls, waterfalls, almost everything she thought might come up. Then the interviewer asked, "How would you calculate the management fee?" She answered quickly, 2% of committed capital. The interviewer paused and asked, "Committed capital, always?" That was where she got stuck. When we discussed it later, I told her, "Your answer wasn't completely wrong, you just stopped too early." And that is what makes management fee questions tricky. The maths is usually simple, the assumptions are not. A management fee is the recurring fee that helps the investment manager run the fund. It supports things like the investment team, deal sourcing, due diligence, portfolio monitoring, and investor reporting. And unlike carried interest, it generally does not wait for the fund to make a profit. The simple way I remember it is this: management fee keeps the machine running, carry rewards what the machine produces. Now back to the interview. I gave Anisha a fund with $200 million of committed capital and a management fee of 2% per year. I asked, "What is the management fee?" She said, $4 million. I said, "Correct. If I am asking for the annual fee, what if I want the fee for 1 quarter?" Now time matters. $200 million multiplied by 2% multiplied by 3 months over 12 months. That gives a quarterly fee of $1 million. So before you calculate anything, you need three things: the fee base, the rate, and the time period. Then I told her there is still a problem. That $1 million could also be wrong. She asked, "How?" Because we had quietly assumed that committed capital was the correct fee base, and that was exactly what the interviewer was testing. Stay with the same fund. Total commitments are $200 million. Suppose the limited partnership agreement says that during the investment period, management fee is charged on committed capital. At 2%, the annual fee is $4 million. Now suppose the investment period ends and the fund documents change the fee base to invested capital. If $120 million is invested, the same 2% produces a fee of $2.4 million. And in another structure, suppose the relevant base is $80 million of net invested capital. Same 2% again. Now the fee is $1.6 million. Same headline rate, completely different fee. That was when I told Anisha, management fee is not really a percentage question, it is a document question. Depending on the fund terms, the fee base could be committed capital, invested capital, net invested capital, cost, NAV, assets under management, or another negotiated basis. There is no universal rule that every fund follows the same sequence. So whenever someone tells me the management fee is 2%, I want to know two things: 2% of what and for which period, because the answer can change as the fund moves through its life cycle. During the investment period, many private equity funds use commitments as the fee base. Later, the fund documents may reduce the rate, change the fee base, or do both. So do not memorize 2% of committed capital as the answer. Memorize the questions. What is the rate? What is the fee base? What period are we calculating? And what do the fund documents actually say? Anisha thought that was the hard part. It was not. Because calculating the fee is only the beginning. The next question is what happens after that fee enters the books. So I gave Anisha another situation. The quarter ends on March 31st and the fund has calculated a $1 million management fee. But the cash will not actually be paid to the general partner until April 20th. She asked, "So do we record the fee in April when we pay it?" No. And this is where people often mix up accounting with cash. If the fee relates to the quarter ending March 31st, that is the period where the expense belongs. So the fund can recognize the management fee expense at quarter end and create a payable. The cash can leave later. I explained it to her this way: accrual tells you which period owns the expense. Payment tells you when the cash actually left the bank. two different questions. Once that makes sense, the journal entries are much easier. At accrual, you recognize the expense and create the payable. When the fund pays the fee, you clear the payable and reduce cash. I would not start by memorizing the debit and credit. Understand the event first, and the accounting usually follows. Then I asked, if we accrue this management fee, what actually happens to the fund? Management fee is an expense, so everything else being equal, net assets fall. That means NAV falls. And that economic impact is reflected across investors based on the fund's allocation methodology. Then I asked, does the investor's unfunded commitment also fall immediately just because we accrued the fee? She said yes. That was the next trap. Accruing an expense and calling capital are not the same event. The expense affects the economics of the fund and its NAV. If the fund later issues a capital call to finance that fee, the capital call may reduce the investor's remaining unfunded commitment depending on the fund terms. So remember the distinction. The accrual affects the economics. The capital call affects the remaining commitment. They are connected, but they are not the same event. Then I gave her one final problem. Suppose the gross management fee for the quarter is $500,000, but the general partner has also earned $200,000 of other fees. I asked, do the investors now bear only $300,000? She said yes, and I said maybe, because management fee offsets are not automatic. Depending on the fund documents and any side letters, certain transaction fees, monitoring fees, directors' fees, or other income earned by the general partner may reduce the management fee charged to the fund. But you still have to check what qualifies, which fees are eligible. Is the offset 100% or only part of the amount? Are there caps? Are there exceptions? So in our example, if the full $200,000 qualifies, a $500,000 gross fee becomes $300,000 net. If only part qualifies, the answer changes again. Now look at how far we have come from the original question. What is the management fee? We started with 2%, but to answer it properly, we needed the fee base, the rate, the period, the fund life cycle, accrual versus payment, the impact on NAV, investor capital, capital calls, unfunded commitment, and offsets. That is why I told Anisha not to memorize one formula. Use a framework. First, confirm the fee base, then the rate, then the period. After that, check the fund terms for step downs, special arrangements, and offsets. And once you have the number, follow where it goes. Does it create an expense? What happens to NAV? How is the impact allocated? Has cash moved? Has capital been called? Are there eligible offsets? A few days later, I asked Anisha the original question again. What is the management fee? This time she did not say 2% of committed capital. She said, before I calculate it, I would confirm the applicable fee base, the annual rate, the period, any step downs, and any eligible offsets under the fund documents. That is a completely different answer, and that is the real lesson. Management fee is not difficult because the maths is difficult. It is difficult because one wrong assumption can change everything that follows: the expense, NAV, investor capital, cash, unfunded commitment, and reporting. So the next time you see a 2% management fee, do not reach for the calculator first. Ask what the 2% applies to. Ask when it applies. Then follow what happens after the fee is calculated. If you are preparing for fund accounting or private markets interviews, subscribe to the Fund Desk. Here, we do not stop at the formula. We follow where the number goes.